A bit of background on Relab. We're a property data platform for those that don't know, and we're all about empowering property professionals with the best tools. So this webinar is part of our efforts to provide valuable insights to you on everything to help you make really good real estate decisions. And we're lucky to have Jarrod Kerr, our Chief Economist at Kiwi Bank, who's very qualified for the job. So Jarrod was born and educated in New Zealand. He's worked all over the world, and he started at JP Morgan in Sydney, then moved to Commonwealth Bank in Australia, and later became head of Australia at Credit Swazi in Singapore. So thank you for joining us, Jarrod, and we're excited to hear what you have to say.
Yeah, thank you, and thank you for inviting me to chat today. There is a lot going on out there at the moment, a lot of uncertainty amongst businesses, a lot of talk of the recession and the recession continuing, and just how tough businesses and households have it at the moment. What I'm going to do is I'm going to look through the next 6 to 12 months and actually lift our heads and start thinking about how 2025-26 is likely to play out, because I think it's easy to get bogged down in all the negative press, but we need to sort of step back like a macroeconomist does and think through more the medium term, which is where I see things improving, and the opportunities that are arising today are I think worth taking. So the title of my presentation is Survive Till 25. We had a client event, and one of the business owners was saying that. I think he had heard it from others, and it sounds like it's a little bit of a mantra at the moment, with businesses facing all sorts of issues, rising costs, reduced profitability, high interest rates are hurting clearly, and it was a bit of a mindset. We've just got to get through the next 6 to 12 months, and then things will be better next year. And I kind of liked it, so we've used it in our Outlook note that we published the other day. From everyone on this call, the main message is it's all about inflation. Inflation's been the problem for the last couple of years, and the path for inflation will ultimately be the path for interest rates. So inflation is declining, which is great. There's still some hurdles that we need to jump over, but I think inflation will be back within the Reserve Bank's target band by the end of this year, and that'll enable them to cut a lot sooner than what they think. We think the Reserve Bank is overly aggressive at the moment. So if we can flick to my next slide, please.
Mm-hmm.
So just to summarize, how we're seeing things in housing at the moment. Look, sales are starting to pick up. We are hearing that there is activity going on. It doesn't feel like it's strong, but it's definitely ticking over. And we think that sales activity will pick up into spring and over summer. And as we get rate cuts, potentially as early as November, that'll accelerate things. And we'll see, house prices, continuing to lift, I think, into next year. And we're forecasting, house prices rising somewhere between 5 and 7% next year, which psychologically is important for the market. It's important for everyone in the market. It's very difficult to develop. It's very difficult to invest in a market where prices are declining. It's hard to get your pre-sales. It's hard to get that premium price that you need as a builder. That I think turns around next year. But as I said, it's all about inflation. So let's have a chat about inflation. If we can go to the next slide, please. Globally, inflation is headed in the right direction, which is great. If you look at those inflation rates out of the larger countries around the world, looking at the US, looking at UK and the Eurozone, China, inflation has declined quite a bit actually, and in the UK and in the Eurozone, it's pretty much back to 2%. So this is why the central bank of the EU, the ECB, has started cutting. That's why the Bank of Canada has started cutting. It's why the Swiss National Bank and the Swedish National Bank have started cutting. And it's why the Fed, the US Fed, will start cutting this year. China's its own problem. China's its own beast. They are cutting there, and we'll do a lot more stimulus because the Chinese economy is particularly weak. Their property market's particularly weak. But that red line just shows you that we're not importing a lot of inflation from China, which is great. So when we think about half of our inflation basket, which is priced offshore, so tradables inflation in New Zealand's dropped dramatically, and that's because these inflation rates around the world have fallen so quickly, which is comforting. There are always hurdles, and another hurdle which has just sort of reared its ugly head in recent weeks is the bounce in shipping costs. Some of our business customers who are exporters and importers have told us that shipping costs for freight out of New Zealand into Asia and into into Europe, etc., has picked up quite a bit. It's spiked a lot. That's an added cost that we're just going to have to work through near term. So good news on global inflation, not so good news on shipping costs, but we'll work our way through that. If we can jump to the next one.
Mm-hmm.
So here's our inflation forecast. What we're saying is, look, tradables inflation has dropped and it will continue to drop. So that half of the basket is doing the heavy lifting, and we're seeing that tradables inflation, which was well over 8%, it was about 8.5% at the peak. It's about 1.6% now, and we see it falling closer to zero into 2025. So that is good. The more sticky, difficult inflation is the domestically generated stuff. It's only fallen from about 6.8 to 5.8, but we do forecast quite a substantial fall in domestic inflation over the second half of this year. So if we look at the headline rate, which everyone knows, it was over 7%, it sort of peaked at 7.3, dropped into the 6s, into the 5s, now it's at 4. By the end of the year, it'll be at sort of 2.8, 2.9. So that's good. That's very good news. If that comes through, which we think it will, we've grown in our confidence that domestic inflation is being tamed. If that happens, then the timing of rate cuts becomes live. So yeah, we're at 4 now, we'll be at 3.5 in the next quarter, but it's the third quarter of this year. It's that September quarter where we see the headline rate just creeping below 3% and hitting about 2.8, 2.9. If that happens, well, that opens up the door for rate cuts. So that third quarter number will be published in mid-October. So the Reserve Bank will be going into their November decision armed with that information. And I think that information will enable them to say, hey, look, inflation is back within band. It's clearly headed towards 2% over 2025. Enough's enough, job done. Let's talk about rate cuts. Next. And you can see some of the areas where we experienced a lot of inflation, particularly in the housing market, has come off. Building costs are coming off. The price of steel is falling. There's there's some major costs that we've had in recent years that have actually started to come down. Now, this is encouraging for investors. It is encouraging for anyone who wants to build a house in the next year or so. And on that chart on the right there, we've just highlighted a pickup in rents. That pickup in rent is on the back of a migration boom. This, for me, reflects the shortage of housing in this country, but it also will start, I think, getting investors interested again, because rental yields will improve for the rest of this year and into next year. So rents are rising because of a shortage. House prices have obviously fallen and moving sideways at the moment. So rental yields are actually picking up, which will bring investors back into the market. Next one, please. We're still working our way through the impacts of Cyclone Gabrielle. The main point I want to make here is, the lack of infrastructure investment that we've done for decades is a real problem, and we're not as resilient as we should be, particularly for a developed economy. So a lot more spending needs to go into here, a lot more spending from the government, from councils, but also, the general public are going to have to spend more and more on making dwellings more resilient. So these weather events that seem to be getting worse and more frequent are, a problem for our infrastructure and our stock. So if we go to the next chart, we've seen dwelling insurance spike, and this is something that we all need to be mindful of. There are some areas, where dwelling insurance is up 20-30%, and council rates are also up, so 20-30% in parts. That's being passed through into higher rents as well. This will only continue. The main insurers are telling us that they are reassessing the risk that they have with, rising sea levels and climate change and everything that's been thrown at us recently. So insurance costs are just going to get, more and more expensive. IAG, as I've written here, has said that there's 20,000 homes in New Zealand at risk of flooding, at severe risk of flooding. So that's just another 20,000 homes that we have to effectively rebuild. So it just adds to the shortage that's going to come through in coming years. And the thing that we all have to note is that insurance is already starting to put in exclusions and potentially even stop providing insurance in certain areas. So these houses that are flagged as severe risk of flooding, that they're going to struggle to get insurance. And from a bank's perspective, we'll be watching how that plays out quite closely, because we have to put mortgages on properties that potentially are at risk of flooding. And from our point of view, if insurers stop insuring, we may not be able to provide a mortgage on that property, and that would obviously be a significant event for that property. Good luck trying to sell a house that can't get insurance and can't get a mortgage. So this is something that's we're going to be watching very closely in coming years. But from a macro perspective, it's just a growing shortage of homes in this country that we need to address. Could go to the next slide, please. Now, with all of that going on, expectations of inflation are falling, which is great. The good news is that when the Reserve Bank asked professional forecasters like myself and the CEOs, CFOs of large companies, the expectations of inflation have been sort of dropping quite a lot actually since the peak, and expectations of where inflation is going to land in coming years is well within the Reserve Bank's band, and that's self-reinforcing. So if you expect inflation rates to come down, your pricing does the same in the economy, and it becomes self-fulfilling. So we've seen inflation fall. People are expecting inflation to continue to fall, and pricing activity is a lot softer than what it was a year ago. So the quarterly survey of business opinion that came out from NZIER earlier this week showed that businesses are not passing on as much inflation to their customers as they were a year ago. This is really good news. It is really good news. It looks like the inflation dragon has been slayed, and we're just waiting for it to hit the turf. Let's go to the next one. Now, let's say we're right. Let's say that the Kiwi Bank inflation forecast is bang on, and that we wake up in mid-October and we see a third quarter inflation report that says 2.8%, and then everyone's forecasts are for inflation to hit 2% next year. Well, then November becomes live, and we are forecasting the Reserve Bank to start cutting in November, which is almost a year ahead of when they think they're going to cut. But the timing is kind of one thing. We might be wrong on the timing. It might not happen until February. You know what? That doesn't really matter. What matters is that when they go, and we're convinced the next move is a cut, not a hike, and when they start cutting, it's not a decision to deliver 25 basis points or 50 basis points. It's actually a decision to take the cash rate back to a neutral setting. So it's very restrictive at the moment, and a neutral setting is around 275 according to the Reserve Bank. That means there's over 150 basis points of cuts to come. So if they take it back to 3%, which is kind of where we're thinking things will end up next year, that's 150 basis points of cuts. That's a big move. That is taking a 5.5% cash rate back to 3%, and potentially going below it if they have to stimulate a little bit. That's a big move. It's a big move for rates, and that's what we think is coming. And this is going to be the catalyst for the recovery in the housing market and the economy in general. So if we go to the next one. So what does that do? Well, obviously mortgage rates were very, very low a few years ago. In 2021, they hit the lowest level ever recorded, even below the lows that we had in the 1950s after a world war. These rates that we saw in 2021, you could get a mortgage rate of about 2.1, 2.2. People made decisions on those rates, and they woke up a year and a half later with a mortgage rate that had doubled and then tripled. And you can see that those 2% rates became 7% rates, which is a massive increase in interest expense. Today, people are expecting what we're expecting, and that is for the next move to be rate cuts. And you can see that a lot of people are fixing for 6 months to 1 year just to get through this next 6 months or a year. The survive till 25 type mentality, and then hopefully we do wake up at the end of this year or somewhere in the middle of next year, and interest rates, mortgage rates, business lending rates will all be down 1 to 2 percentage points. So that's what we're thinking. Our customers agree with us. We can see them shortening up their mortgage tenors, and hopefully that all comes through, because we need it. We need that interest rate relief sooner rather than later. Next one, please. Of course, we are seeing a lift in defaults. That happens when you go through a recession, unfortunately, and this is at the hands of the Reserve Bank. They knew that this would happen, and it's part of the process. And we're seeing customers who are stressed being one thing, but then a few customers that are actually defaulting. The important point here is that the level of default is really low. It's even the forecast lift in default rates over the rest of this year, as the unemployment rate lifts, it's still really low. It's very unfortunate that we have to go through this, but it's important to note we're coming from a very strong starting point, and banks have put money aside, ourselves included, for a lift in defaults later this year. So we are prepared for it. And obviously, we do everything we can to help these households. We can put you on interest only. We can, you can stop payments altogether for, I think, 6 months. And there's a lot that can happen. If anyone is stressed, contact your bank ASAP. Don't let it get worse. But this is the damage. This is the scarring from aggressive monetary policy to get inflation down. To put it in perspective, household defaults are very low when you think about business and agriculture in particular. What's going on there? So here's our forecasts. That green line, I think, says it all. We're expecting the cash rate to be cut to 3%, and then I think there's a risk they have to stimulate a little bit and cut to 2.5%, but that's a story for another day. For now, I just want people on this call to realise that if they do start cutting in November or February or May, we might be wrong on timing, but we won't be wrong on direction, and we will not be wrong on magnitude. There will be significant cuts coming through. And you can see it's not just a mortgage rate that gets cut. We obviously fund ourselves with term deposits and people putting money into the bank. Savings rates will be slashed. So the savers out there also need to think about what they're doing with their interest rate. Do you want a 6-month term deposit? Do you want a year, or do you want to think a little longer and go out further? Should the economists be right and interest rates are gutted next year? So I would be thinking longer term as a saver, and I'll be thinking short term as a borrower. Let's try the next one. One of the things that has us concerned, but also more confident in cuts, is the business sentiment out there, which is clearly weak. We had a bit of a post-election bounce. Hey, we've got a new government. Hey, it's a national government. They're going to be pro-business. There was a bit of excitement there. Didn't last. The realities of the world have kicked back in again. Hiring intentions has dropped. Investment intentions has dropped. When you see that, it kills economic growth almost overnight. So, businesses, they really do have their heads down at the moment. They're putting out fires. They've got the tunnel vision. I've got to survive till 25, and you can see that in these surveys. What are they concerned about? Well, they've still got, costs as a major concern. Profitability is deteriorating. You can't expect businesses to go, oh, well, why don't I think about 2025, 26, which is what we're asking them to do. it's very difficult when you're putting out fires and trying to survive the next 6 months. Those that do have the ability to sort of step back and think, go to that next slide, that's a good one, do have the ability to step back, are actually looking at the opportunities. And for those who are in that privileged position, I think you'll do very well next couple of years. You can see on this chart that labour was a concern, a year and a half ago. Just can't find the workers, they're not here. I'm having to pay 20% to get a worker on board, or to stop a worker from leaving. It was very, very tight labour market. That's loosened right up with the migration boom. Labour is not a concern for most businesses. What is their concern is demand for their product or service. Again, this is the sort of stuff you see when you've gone through a recession, and we've been through quite a bad recession. We can't sort of downplay that at all. Let's try the next one. Here's a chart from Westpac. Good data that goes back to the 80s. Businesses clearly worried. As I said in the previous slide, households worried too. Okay, households are being hit, cost of living crisis. They're now more worried about job security than they were a year ago. They've also been slapped with a tripling in their interest expense. Households are doing it tough, and you look at that level of consumer confidence, how low it is, and you go right back to the 80s. It was lower than what we saw in 89, going into 90, 91, 92, the big recession back then. Households are not happy, and you can understand it, right? You can understand it for those reasons I said just before. When you really need that to turn around, and it's not going to turn around until later this year. But there are things that will help. Wages are still rising. The growth in wages is cooling a bit, but wages are still rising, and they will be rising above inflation for the first time in a very long time in the second half of this year and over 2025-26. So that cost of living crisis will slowly work its way, work out as wage growth exceeds inflation, and that's important. We're expecting that in the second half of this year, and that'll help shore up some confidence. This chart here on per capita GDP just shows you how bad the recession is. We've had a lot of people come into this economy, a lot of migrants, but when you look at the piece of the economic pie, we've had a contraction of 3%, which is worse than what we saw during the GFC. So, keep that in mind. The headline numbers are bad, but geez, when you scratch beneath the surface, they're even worse. Let's try the next one. With all of this, we are expecting the unemployment rate to lift to about 5.2. Big lift from 3.2, but not as worrying as we saw post GFC when the unemployment rate was in the sort of 6 to 7% range. It is a lift. Many households are struggling, but most are doing okay, and things will improve. I better start speeding up through these. As I said, with the migration, we've had an incredible bounce in migration coming out of COVID. We had the largest migration boom in New Zealand's history between 2013 and 19. I just looked through COVID, and I think that migration boom has just continued, really. The demand to come to New Zealand has not dropped away as many had feared. New Zealand's still a very attractive place. We've brought in 140 plus thousand net migrants over the last year. That's massive. We are not building the infrastructure for this surge in population. We are not building the houses for this surge in migration. So it's just going to tighten up an already tight housing market and put upward pressure on prices for the wrong reasons. So we really do need supply to address this. The other good news is tourism. Decent bounce back in tourism there. We're seeing that in Queenstown and other hot spots around the country. This is good news. We're back to 80%, not 100%. The reason we're not at 100% is because the Chinese tourist hasn't returned. The Australian tourists, straight back. Aussies have got nowhere better to go, and our other tourist destinations have picked up. So this is good news. Next one. Like I said, the supply is the big issue. With a falling housing market, we're starting to see a fall in supply, which is precisely what we don't need. If you think about policy over the last few years, the investor was very much the bad agent. They were making money during the boom that we saw straight out of COVID. And then you had the government attack the investor with the bright line test, with interest deductibility. Even triple CFA didn't help. And then you had the Reserve Bank attack the investor as well with tight LVR restrictions and obviously lifting interest rates. That was precisely the wrong thing to do. We should be encouraging investors to supply more houses, and I think we'll see more of that in coming years. Let's go to the next one.
Next one.
Yeah, and the next one. I want to open up to some Q&A. Some good news in here is that we are starting to see, some tentative signs of recovery in the housing market. We're hearing it from mortgage brokers that we deal with. We're hearing it from mobile mortgage managers within Kiwi Bank. That there is a little bit of a lift in activity. There is a little bit of a decline in the days to sell. What we monitor for, house prices does look like things have stabilized. They've gone sideways for a while, but I do think things will pick up in the second half of this year, and there are a lot of reasons for that. As I said, investors were attacked by the government and the Reserve Bank. That's now reversed. The bright line test has gone from 10 to 2. 2 years is not long when you're an investor, to be fair. It takes 2 years for a council to reply to an email, let alone get consent. So I don't think that's gonna hurt investors anymore. And then the return of interest deductibility is, I think, a good thing and helpful. And then, of course, we'll have rate cuts, I think, from later this year, and maybe a bit of a relaxing of LVR restrictions as DTIs are put on. But I think net is going to be a positive for our housing market. And I'll probably finish up. What's the next slide? I can't remember off the top of my head. Yeah, there you go. So that's our house price forecast. We've been through the correction. It is just a matter of time for the housing market, and I think it's stabilized, and we'll get 5 to 7% ish growth next year and into 2026-27. So that should encourage investors back in. It should make first home buyers more comfortable, and everyone else, all the other owner occupiers. A slow and steady rise in house prices helps confidence across the board.
Mm-hmm.
So why don't we call it there? I'm happy to talk about LVRs. I'm happy to talk about DTIs. I'm happy to talk about anything you want to discuss on the housing market. I see we started to get a few questions coming through. Please send through more questions. We've got plenty of time.
Yeah. Are there any of those questions that jump out to you, Jarrod?
Okay, well, the first one, how many basis point cuts is the RBNZ allowed to do if they start cutting rates? Do they have to go down by 25 basis points, or can they go down more aggressively yet? Manus, that's a good question. And the first one is they can do whatever they like. They can do whatever they see fit. We've seen in previous rate cutting cycles, they can cut by 50 basis points. During the GFC in 2008, from memory, they did one cut of 100 basis points, and I think they did another cut of 150 basis points in one go, like in one meeting. I think there is a chance that they start off with a 50, and maybe it's November, maybe it's February, but maybe they go, look, hey, we have beaten inflation, we're happy it's getting to 2%. We do need to get down to 3 quite quickly. I could see that happening, and them maybe delivering a couple of 50 basis point moves just to get there quicker. So there's no rules when it comes to this sort of stuff. There's no rules as to how far they can go either. If you remember, during COVID, they cut to 0.25%, so 25 basis points, and they had all the banks prepared for a negative interest rate. So, when I went to uni, there was no such thing as a negative interest rate. But during COVID, $18 trillion globally was invested in bonds with a negative interest rate. So there's no floor like we thought there was, and there's no rules. They do what they deem necessary for the economy at that point in time.
And then we've got a question from AJ. So, Housing Minister Chris Bishop announced plan to flood the market with land development and reform to remove council powers over urban boundaries. What are your thoughts on it?
Look, anything that increases the supply, I'm all for. And we talk a lot about demand, and it's the wrong side of the coin. We talk a lot about, we've got more migrants, or investors are doing such and such, or it doesn't. No. Everything that is wrong with the New Zealand housing market is on the supply side. We've had big migration booms over time, and we haven't increased the supply of dwellings quite simply. And there's a lot that goes into that. There's the availability of land and the infrastructure required to make that land available. So if we've underspent, under-delivered on infrastructure for decades, then the availability of land has been choked because of that. And Auckland's a classic example. We have this idea that there's not much land out there. Well, take a look at the map of New Zealand and compare it to the UK and to other parts of the world. We've got heaps of land. And that's not an excuse. The issue is, we are not developing that land properly and efficiently enough. So I don't care what the policy is. Anything that increases the supply of homes in this country, needs to be fast tracked, needs to be done in order to tackle this shortage that we have. And we estimated the shortage in 2018 at 100,000. That research was used, and you remember Kiwi Build was to tackle 100,000. That has changed a little bit over time, but there's still a massive shortage. It's still at least 60, 70,000 dwellings, and getting worse again.
Thanks. And have you got time for one more question, Jarrod?
Yeah.
Cool. So this one's around the macro impacts of like global insecurity on falling interest rates.
Oh yeah, I mean, geopolitically, this year is a really interesting one with all the elections that are taking place, and we've seen some shifts, some further shifts, I should say, to more populist parties, even to more far right parties around the world. That happens in bad economic times. We've seen it numerous times in our history. You know, this fed up people that are just fed up with the current situation, voting further to the right or left as they demand change. And you know, Kiwis have been doing it tough for 2 years now. 2 years. You know, the slowdown really started in the second half of 2022. So we're 2 years into this. And you know, when you're fed up, you vote for change. You know, Trump coming back in, I don't know what that's going to do to asset markets. I don't know what that's going to do to thoughts around global trade. I do know that you know, people will be looking at the US less favorably, but I don't think that'll impact us directly. You know, that there are some big changes happening around the world and risks being priced in. All of it just points to a central bank here that probably needs to be a bit easier on monetary policy with all this uncertainty. Do the new DTI rules mean the old loan to value ratios serviceability will not be taken? No, they'll both be taken into account. So the DTI is debt to income. You know, it's this kind of lending or a speed limit on lending to high DTIs. So you know, people with debt to income of over 6 or 7, there's a speed limit of sort of 20%. I do have a couple of charts in there on that, but basically it won't have a big impact now. The whole point of DTIs is to restrict the next housing boom. Had those DTIs been in place in 2020-21, you wouldn't have seen as much lending into that high DTI space. The LVR restrictions, I think, will actually be reduced. Can't even pick a word. Reduced over the next year or so as the DTIs come on. So give with one hand, take with the other. The Reserve Bank really is setting itself up for the next housing boom, which could be 2, 3, 5 years away, and making sure that banks don't over leverage or allow too much leverage in the next housing boom.
Thanks, Jarrod. Yeah, I think we'll wrap it up there. Thank you again so much. It's great to get your insights.
Thank you, and thank you everyone for dialing in today.